Buying a brand new $40,000 luxury electric car usually means a heavy monthly payment. But one specific transaction managed to drop the net out-of-pocket cost of owning a Tesla Model 3 down to exactly $78.39 a month. When finance influencers claim to drive a new car for free, the immediate instinct is to look for the catch. The assumption is usually that it involves aggressive leasing terms, brand sponsorships, or questionable accounting tricks. Even the manufacturer utilizes psychological pricing to manipulate the numbers. This checkout interface shows how Tesla presents their costs. They take the base price of the vehicle and immediately subtract an estimated gas savings over 6 years, artificially lowering the display price right on the screen. We are going to strip away the marketing strategies and perform a strict forensic audit on this exact transaction. By looking at the hard numbers, we can see if this $78 price tag is just internet clickbait or the result of a highly optimized tax blueprint. Here on this ledger, we begin with the true retail price. The buyer selected a base standard range Model 3 priced at $35,000. Adding black paint and the autopilot feature pushes the actual purchase price to exactly $40,000. The buyer didn't hand over cash. They took an offer for 100% financing, putting zero down and securing a 3.75% interest rate stretched over 72 months. That specific loan structure creates a monthly payment of $640. Add in the out-of-pocket costs for sales tax, the license fee, and registration, and the total cash outflow for the first year comes out to $12,117. That $12,000 figure is our baseline reality. Before any strategic maneuvers are applied, this vehicle is a massive, immediate cash liability. To start dismantling that initial cost, the buyer relied on local government intervention. Returning to the ledger, the first major reduction comes from California's electric vehicle rebate program. Because of where the buyer lives, the state literally mails them a check for $2,500 upon showing proof of purchase. Next, the vehicle qualified for a $3,750 federal tax credit. Subtracting both of these direct subsidies pulls the first year's total out-of-pocket cost down to $5,867. There is a strict mechanism behind that federal credit. You only receive that money if you actually pay more than $3,750 in federal taxes to begin with. If your tax burden is lower than the credit, it loses its cash value entirely. The localized and federal incentives successfully cut the first year out-of-pocket expenses in half. But sitting at nearly $6,000, we are still far away from reaching $78 a month. The variable that bridges the gap between a $6,000 expense and an almost zero-cost vehicle relies on how the buyer classifies the purchase, specifically buying it for business use. Looking at this new column on the ledger, we can see the immediate impact of that classification. The $1,438 spent entirely on loan interest during the first year legally becomes a tax write-off. The $4,437 paid up front for taxes, licensing, and registration is also added directly to the deduction column. Finally, they apply the heaviest deduction. The buyer writes off the vehicle's first-year asset depreciation, calculated here at roughly $8,200. All combined, this creates a total tax deduction of about $14,000. A $14,000 write-off does not mean the government hands you $14,000. It means you reduce your taxable income by that amount. For this specific buyer's tax bracket, shielding that income from the IRS results in a real-world cash savings of $4,925. This final calculation block shows what happens when we apply those actual cash savings back to the equation. Taking the remaining out-of-pocket cost of $5,867 and subtracting the taxes saved, the total first-year cost of the vehicle drops to just $942. Divide that net yearly cost by 12 months, and you land precisely at an out-of-pocket net cost of $78.39 per month. The manufacturer didn't discount this car. The buyer achieved this pricing by meticulously applying tax code regulations to redirect capital away from their IRS bill and directly into the equity of a physical asset. Seeing a number that low naturally leads to the question of whether an average consumer could replicate this exact financial strategy on their own checkout page. You need a credit score high enough to secure a 100% loan at an exceptionally low interest rate. This checklist breaks down the specific variables required for this equation to work. You must live in a state that offers aggressive direct vehicle rebates. You need a federal tax burden large enough to absorb available credits. This strategy is contingent on the final checklist item. You must operate an eligible business entity to qualify for deductions on asset depreciation, loan interest, and registration fees. Without a high income, a specific geographical location, and a qualifying corporate structure, the calculation fails. This $78 monthly cost is less of a consumer deal and more of a highly specific financial result available only to those who meet every one of these prerequisites. Despite having the cash on hand, individuals who optimize their finances rarely purchase depreciating assets outright. Tying up $40,000 in a car guarantees that capital will slowly evaporate over time as the vehicle loses value. This visualization shows the mechanism of leverage. By borrowing money at a low 3.75% rate, the buyer preserves their personal capital. They can then deploy that $40,000 into investments, yielding a return much higher than the interest paid on the auto loan. In this system, the federal tax code acts as an operational subsidy. When applied correctly, it shifts the financial weight of acquiring assets away from the individual and onto the ledger of the government. Building wealth at this level requires stepping away from asking how much an item costs. The true mathematical leverage comes from asking how you can structure the transaction so the system pays for it instead.